Hello and welcome to the Chilled Investor. This is not financial advice. Always do your own research. Today I'll be talking about why I think share prices tend to drop on the ex-dividend date and what I do about it. So the first reason for share price drop is normally because people are selling it rather than buying it. So demand goes down and supply goes up, and obviously that price then drops. Now, the reason many people sell on the ex-dividend date is because if you're getting a 5% payment on that one day, for example, and then you sell that, you're then going to get your 5% payment and then buy another share in a different company and possibly get 3-4% payment on that one, and so on. And so you can take many payments off one lump of money if you can trade it quick enough before the price drops too far. So the next reason why I think that share prices tend to go down on the ex-dividend date is because of a drop in value of the actual company itself. Now, the reason I say this is because when we value a company, we take many things into account, such as the assets that company has, the turnover the company has, the profit margins, and of course, the cash in hand. Now, if you've got £1 billion cash in hand and £500 million goes directly to the shareholders, you've just dropped that value by half. So when adding all that together, the value of the company now is less than it was previously. So on the next dividend day, where you're looking at taking a 5% dividend, the price is probably going to drop between 5 and 10%, depending on the company. Some do better, some do worse. And this is the reason why I like to have quarterly paying dividends, because it makes the share price much more stable, because they're paying out a lot less, but more regular. Plus the fact if you do sell a quarterly paying one, chances are you might miss the next dividend date before you can get a reinvestment at a good price. So what to do when the ex-dividend date is just round the corner and you're looking to invest? Now, it's nice to think we can time the market, but in reality we can only do so much. So for me, if the share price has gone right up just before the ex date, I'll tend to keep away and just take the discount what comes with the ex-dividend date as the price drops, and I'll make my investment then. But if the price has stayed really stable or even dropped off a little bit in the approach to it, then I'll make an investment, but I'll hold so much back. So if the price does crash out straight after the ex date, then I'll double the investment up. That way I reduce my overall cost of the share. When buying shares, it's important to consider any commission fees that you might incur, especially if you're going to split your investment before and after the ex-dividend date. Now, for me, I use a trading 212 account, so that's not a concern as they don't charge any commission fees. Now, the danger with an account like this is when you can invest from as little as £1 at a time, it's quite easy just to buy things on a whim without thinking too much about it, without doing your research. And that can lead to issues in the future, as £10 here, £20 there, oh, it's gone down a bit, let's purchase a bit more. You can soon end up with a few £100 invested in a company that you know little or nothing about. So you really still have to do all your research as you usually would. If you found this video useful, please think about subscribing. And if you like the video, please give it a thumbs up. If there's anything else you want me to discuss, stocks and shares related, please feel free to drop us a comment and I'll see what I can put together. Thanks for watching and I'll catch you next time.